it was looking cheap, and I know several people asked me why I wasn't looking at free, because it was looking cheap to a lot of dividend people. So be careful what you wish for, you find out, right? Same thing with rig, right? Look cheap, look cheap, look cheap, and then you found out why it looked cheap. Right? Maybe there'll be an opportunity. Okay. So reminder again that your DCF valuations are due next Friday. So if you haven't started working on them, time to get started. A couple of you have already sent in your DCF valuations, and I've sent them back. So if you do it, so if you don't wait till 5 o'clock next Friday, you probably get it back within 20 minutes of sending it to me. So it's not some extraordinarily detailed process that I'm going to go through, but I will go through your DCF and send it back. So if you send it, so you don't have to wait till next Friday is what I'm saying. So if you get done earlier and you think you're pretty comfortable with what you've done, Send it to me. Two things that I don't want to see. One is investment banking valuation models that are used from last summer that you're still holding on to. Keep them for investment banks. That's the one thing that's going to freak me out, is that table at the bottom that shows me what the terminal value will be as of 6 times EBITDA. If I see that, I am freaking out. Okay? So no investment banking valuation models. You can build your own spreadsheet. You can use one of mine. I'm not stuck on either. So also don't send it in with big chunks of missing items, like your income was missing, your capex is missing, and say, why don't you fill it in for me? I'm not doing that either. So I'm willing to kind of work with you, but you've got to kind of at least give it an honest first attempt at valuing the company. So today we're going to continue valuing companies, and we're going to run into a bunch of different issues along the way. So here's one of the things we're going to talk about. We're going to talk about valuing emerging market companies. Very good ones, very bad ones. But what they often share in common, and this is not just emerging market companies, obviously it can be with any company, is that some of them have terrible corporate governance. And I won't define it for the moment. I'll let you decide what that actually means. So let's say you're looking at a company. It's badly managed and has very poor corporate governance. You do a discounted cash flow valuation and come up with $100 million for this company as the value of the company. Should you discount this value for bad corporate governance?
No.
Sure. Why not?
It should already be built in your assumptions.
Back to flesh that out for me. What do you mean built into your assumptions? In what way?
Poor corporate governance is going to be reflected in inconsistent or lower growth rates. Margins are probably not going to be as high as they should be. Reinvestment policy is not going to.
In other words, every aspect of evaluation reflects that bad. So if you have bad management, it's not just something you're talking about. It's bad margins. You're growing when you shouldn't be, not growing where you should be. Your DCF valuation, if it's done right, should already reflect bad corporate governance. So how do you reflect good corporate governance? And we'll talk about it. What can we do to reflect the fact that sometimes companies go from one side of the line to the other, but you don't, and this is actually a generic point. If you did your DCF valuation, you should know what you've already built in. So when somebody says, how about this, how about this, how about this, you should be able to say, this is where I've already reflected it. But we will look at a couple of emerging market companies where this is going to become an issue. How do you factor in corporate governance? Here's the second question. Do you see there's a biotech bubble now? At least that's what the Wall Street Journal tells me. The one thing that's always puzzled me about biotech is, what's the tech in biotech? What's so technology? In other words, where is the tech in biotech? Or let me frame it to you differently. What's the difference between Amgen and Upjohn? Or Amgen and Pfizer? I mean, Amgen is supposedly a biotech company and Pfizer is a pharmaceutical company. What's the difference?
Better marketing.
Better marketing? No, to me,
Better marketing.
Jeremy, because you work in the area, tell me what.
I think it's mostly, I think the idea is around like biologics and small molecule drugs, but now they both, I mean, all pharmaceutical companies are doing biologics.
Yes. So basically, until 5 years ago, if I asked you, you'd say the young pharma companies we call biotech, and the more mature pharma companies are called drug companies, right? You say, who cares? Labeling matters. And here's why it matters. Amgen looks like the cheapest company in the biotech sector, but if I move it across the line into the pharmaceutical sector, it looks like the most expensive company. And this is something we're going to come back and talk about in the context of pricing, is where you put your company can make a huge difference in how people price it. And for better or worse, attaching the word technology to you. And this is why I think we need to take the tech out of biotech. Just call it bio companies if need be, but actually lower their values by 30%. I know it sounds extreme, but adding the word technology seems to allow investors to abandon the rules of the game. That's why Tesla likes to call itself a technology company that happens to make automobiles. Uber likes to call it a technology company that happens to provide car service. Shake Shack doesn't, but maybe they should call themselves a technology company that delivers shakes technologically. I mean, everybody wants to be a tech company, because if you're a tech company, here are the things I allow you to do. I allow you to scale up with relatively little reinvestment. Google did, Facebook did. You say, why can't Tesla? Only promise, You have to produce cars. You can't just scale up by just saying, I'm going to produce more cars. You have to build assembly plants. So one thing I would like you to think about as you look at these sectors is these sectors were designed for a very different point in time. And maybe by putting companies into sectors, we start misvaluing them because we give them the characteristics of the sector. But let me return to the test. You have finished a DCF valuation of a pharmaceutical company. You valued it at $20 per share. You've used conventional accounting numbers to arrive at the cash flows and the discount rates. What I mean by conventional accounting is you took the earnings as stated by accountants. You're saying as opposed to what? Well, we said the biggest capex for a pharmaceutical company is R&D. That those numbers are not quite the numbers you should be using. Let's suppose you decide to do the right thing. You decide to capitalize R&D. And remember what it does. It changes everything, right? It changes the operating income, the invested capital, the return on capital, potentially the growth rate. What do you think will happen to your value per share if you took a company and capitalized R&D? I think we've kind of answered this question. Let's make sure we have it nailed down. Will it increase the value per share? Will it decrease the value per share? Will it remain unchanged, or any of the above depending on the company you're looking at? Increase, decrease, no change, or any of the above. What do you think would happen if I did this for Amgen? Increase, decrease? It actually increases the value per share for Amgen when I capitalize R&D. If I did this for Merck, capitalize R&D, it decreases the value per share. I'll let you, and we'll come back and talk about this, decide why you have an increase in one company and a decrease in another. But when somebody says we capitalize R&D, aren't you pushing up the values of all companies? No. We'll push up the values of some companies, we'll decrease the value of others, because it all boils down to how efficiently you do R&D. R&D is neither good nor bad. It could add value, it could destroy value like any other investment. Last question, I'm sorry. You're valuing a distressed company. Distressed in what sense? It's losing money, it has a lot of debt. So I've kind of loaded up the dice here. You estimate the cash flows, you make realistic assumptions about margins improving. I'll let you decide what realistic is. You attach a high cost to capital to reflect the fact that there's a lot of default risk and a lot of debt in the company. And you compute a value of $1 billion for the equity. So you've done a conventional DCF valuation of a distressed company. Even if you've been realistic about all your assumptions, right? Is the value that you're getting from your DCF valuation going to be too low, too high, or just right? Sound Goldilocks like, no. Do you see my question? You've done a DCF valuation of a distressed company. Are you going to overestimate its value or underestimate its value? Tell me why I'm going to overestimate the value.
You're not taking into account the debt into consideration like you should.
When you said I'm not taking the debt into consideration, I am factoring in the debt payments into my cash flows. I am allowing for the risk in but I am valuing this company as a going concern, right? Do all distressed companies become going concerns? No, a lot of them don't. Using a discounted cash flow valuation to value a distressed company will overvalue the company because you're missing the truncation risk. You know what truncation risk is? The risk that your company will not make it. And it's not just distressed companies. Valuing a young startup with a discounted cash flow model will overvalue the company even if you're realistic about your assumptions, because there's truncation risk with young startups. So at either end of the life cycle, you face this risk. What if my company doesn't make it? And what I'm saying is there is nothing you can do in a DCF valuation to reflect that, because DCF valuations are designed for going concerns. You're saying that we're stuck. Not necessarily. We'll talk about what you have to do on top of a DCF valuation to bring in that likelihood that your company will not make it. But if you trust a DCF valuation for a distressed company, even if it's done right, you're going to overvalue the company. So these are all issues we'll come back and talk about as we go through, but let me go back to where I left you on Monday. We were talking about, we valued Con Ed, right? We started easy. Big dividend paying company, mature company, used a stable growth dividend discount model to come up with a value per share very close to the price. I'm going to move one step up the process, but not terribly difficult company to value. I'm going to value 3M. You know what 3M does? Incredibly boring things that make a lot of money. like that technological marvel, the Post-it note. It's amazing. They make about $1 billion every year from Post-it notes in red, blue, pink, green, whatever. You know. A company, we know what it does. We know what business it's in. And this was a valuation that I did on September 12th of 2008. As I've described it, I call this the last day of innocence. Before the crisis, essentially I'm valuing an established company in what I thought was a mature market. This valuation was relatively easy to do because I'm trusting history, and this is the kind of company you can model, and the modeling is going to give you a value very close to fair value because the narrative is set, the story is there, you can see what they're doing, you can see their business model, the margins are stable. So I drew on all the standard tools. So to get the growth rate, I estimated the return on capital and reinvestment rate. I multiplied the two, came up with the growth rate. So in other words, it's pure mechanics in this valuation. I don't have to be too creative. I won't get into the details of the valuation because it's everything we've talked about. You know, cost of capital based on market value weights, bottom-up betas, you know, fundamental growth. The value per share that I got was about $83.55. So conventional DCF valuation. The stock was trading at 70. So if I were true to this valuation, at 3 o'clock on Friday, September 12th, I should have gone online and bought 1,000 shares of 3M because my valuation was telling me the stock was cheap. And of course, on September 15th, that I woken up and saying, what the heck did I do? Because, of course, the crisis started. So here's what I'm going to do, and this is to kind of dispel that myth again that if you have an intrinsic value for a company, it shouldn't change very much. I've heard value investors tell me this, that if you value a company and you do it right, the value should be pretty stable. It's a price that moves around. This is a pretty mature company. I've got a value of $83.55. I valued it 4 weeks later. But those 4 weeks changed the parameters of the game. What's changed? There's nothing that came out from the company. There were no earnings reports, no information, no big announcements. But you know what changed, right? The market shifted around you. In what sense? You had a crisis, equity risk premium shot up. Risk-free rates dropped. The perception that the economy was going to recession became a much stronger one. So 34 days after my first valuation, I revisit this. Nothing micro has changed, right? But a lot of macro things have changed. Lower interest rates, higher risk premiums, lower growth. I reflected the change in risk by increasing both my equity risk premium to an implied premium of 6%, so that's a big jump from the 4%. And the default spread went up to reflect the fact that now you have more default risk to build into the company because the price of risk has gone up. I also reduced my expected growth to reflect the fact that you are now more likely to go into recession. So lower return on capital, lower growth rate. The value per share that I get is $61 per share. $83.55, $61. The intrinsic value per share has changed. Not because I learned something new about the company, but because the world changed around me. Don't let anybody tell you that if you do an intrinsic valuation, somehow that number should stay frozen over time. Because we live in a world where macro variables can shift at the drop of a hat, and when they do, the value per share for your company will as well. It's made investing a lot more difficult in developed markets because we were able to avoid dealing with macro variables for a long time. The advice we got from value investors was just value a company, don't worry about the macro stuff. That might have been okay in 1985 or 95. We can't do that anymore because the value per share can change dramatically even if nothing is changing in your company. Okay. Any questions? Now let's move up the scale. You can value individual companies with discounted cash flow models, right? Can you value the entire market? What if somebody came to you and said, can you tell me whether stocks collectively are undervalued or overvalued? In other words, it's a different version of the question of, is there a bubble in the overall market? I think you can actually take the technology we have for individual companies and scale it up to value an entire market. Let's try. Let's try to value the S&P 500. Let's start simple. Let's try valuing it using a dividend discount model. Let's see what we get. And don't be too terrified when I get the final number because it's a pure dividend discount model. In a dividend discount model, here's what I do. I act like I buy the entire S&P 500. I look at the collective dividends I would receive. I build an expected growth and I discount it back at a cost of equity because it's a dividend discount model. And that's exactly what I did. January 2015, I took the dividends for the previous 12 months coming into January 2015. I grew it at what analysts were projecting as growth rate. And if you don't trust analysts, in a minute I'll give you a way of getting around that problem. At some point, these are the 500 largest market cap companies. The earnings growth has to converge on the growth rate of the economy. And I'm going to use my very simple proxy for that with the risk-free rate. And I discount the dividends back at a cost of equity. And that cost of equity should really be the cost of equity for an average risk stock because we're talking about the S&P 500. So I used to beta 1. And what I got based upon my, and you're saying where did the equity risk premium come from? That's actually the average equity risk premium over the last decade. So I've assumed that the risk premium will converge on that. The value that I get for the S&P 500 was $895. The index was trading at 2058.9. Bubble, right? If you use a dividend discount model, you are going to find a bubble in this market. It's incontestable. And it's been true for about 15 years that using the dividend discount model gives you a value much lower than the index. So play devil's advocate. Before you jump in and sell all your stocks, what are some of the reasons I should be a little cautious about this?
They don't all pay dividends.
They don't all pay dividends, or even if they do pay dividends, they don't pay out what they can afford to. Not even the maximum. You could potentially pay out the whole company. They don't even pay out what they can afford to. How do we know what they can afford to? With individual companies, how do we measure that? We compute the free cash flow to equity. Last year, collectively, dividends paid worked out to about 43% of free cash flow to equity. For every dollar available to be paid out as dividends, 43 cents got paid out. And before you get too surprised about it, when you have free cash flow to equity and you don't pay it out as dividends, there are two things you can do. One is you can use it to buy back stock, and we saw a lot of it used to buy back stock. But if you don't pay dividends and you don't buy back stock, where is it going to show up? It's going to show up as a cash balance. So when you see the 170 billion at Apple or 80 billion at Google, that's the net effect of that. So the first flaw, and the biggest flaw of a dividend discount model is it's looking at a very narrow stretch of cash flows, a narrow portion of cash flows. It's missing the rest. So there's an easy fix for that, right? So here's the first easy fix I did. I replaced the dividends with dividends plus buybacks, saying increasingly U.S. companies don't just use buybacks once in a while. This has become the systematic way in which companies return cash. And notice the change. My dividends were 38.57. My dividends plus buybacks were 100.5. So that obviously changes the game, because instead of starting with this low cash flow, I'm starting with a much higher cash flow. The value that I get for the index then is 2,332, which actually is, so if I look at dividends plus buybacks, stocks actually look undervalued at a 5.11% equity risk premium. Here again, you can play devil's advocate. What's the problem with looking at buybacks? Well, collectively companies might be returning too much cash, right? And there's an easy way I can check again. I can check at dividends plus buybacks as a percentage of earnings against free cash flow to equity. So if you were poking holes, you can say maybe your cash flows are wrong. Maybe your expected growth rate is too high. After all, I'm using analyst projections of growth, right? Who knows? Maybe they're being over optimistic. Is there a way I can fix that analyst growth rate though? If I don't trust analyst forecasts of growth, what could I use instead? If I want to go with something that is sustainable, how do we come up with growth in earnings for individual companies? We looked at
Returns on capital.
return on equity, in this case because it's equity, return on equity times the retention ratio. I could do a fundamental growth rate, ignore analysts entirely, right? So I did a third run where I replaced the growth rate that analysts were projecting with the return on equity times return on, and it's true, the growth rate I get is a fundamental growth rate because companies are returning so much cash back to investors. The retention ratio is only 12%. Why is it so low? Because the buybacks are so big. With that lower retention ratio, the expected growth I get is 2%. That does temper my value. It goes back down to 1992.11. So I have three different valuations, and now you can see why there's so much disagreement about whether the market is in a bubble. Depending on the metric you focus on, you will be able to tell whatever story you want. I think the dividend discount model should not even be on the table. I think a pure buyback induced optimism might be dangerous because buybacks can be here today, gone tomorrow. Are stocks at the start of 2015 undervalued? They might be overvalued, but we're not talking bubble territory. We're talking about 2058 versus 1992, which is what, 5%? So maybe they're overvalued by about 4 to 5%. Is that going to change the way I think about investing? No, because there is enough noise around this process that that's close enough to a fair valuation that I'm going to do what I need to do in terms of picking individual stocks and not let the macro variables drive my decisions. I've been doing this now in this class, in the spring semester, for 21 years, valuing the S&P 500. There have been years where the S&P 500 has come up as tremendously overvalued. I'll give you a classic example. You did this in 2000. You got the S&P 500 being overvalued by 35%. There have been periods where it comes out as undervalued. So in a sense, if I let hubris get to my head, I could start becoming a market timer, right? But I also know how much noise there is in this process, which is the S&P looked overvalued in 97, 98, 99, 2000. Finally, there was a correction. I could say, I told you so. But if you keep saying the market is overvalued, the market is overvalued, there's a bubble, there's a bubble, there's a bubble, sooner or later you will be right. You will get celebrated as that guru of bubbles. But a clock that's stuck at 12 o'clock is going to be right twice every day anyway, right? There are a lot of, I don't even know what to call them, bubblers, bubble maniacs, whatever they are, you know. And the smarter you are, the easier it is to get to that hubris of saying, I think Robert Shiller has actually crossed the line. I think he's let his Nobel Prize go to his head. And effectively, he thinks he can call bubbles when he says, okay, I have a metric, whether it's a Shiller P. I think that we need to be careful about how quickly we jump to the conclusion that something's in a bubble. So this is to assess the entire market. You had a question?
Yeah, why don't we just use the free cash flow to equity?
We could. I'll tell you the problem. I can do this for about 422 stocks out of the S&P 500. You know the 78 I can't do it for? Banks and financial service companies. I can cheat and try to get something there, and I've done it before. But that's really in fact, in other markets, I often use free cash flow to equity, using even banks and financial service companies. But that's been my block. But I think I'm going to get over it and start to use free cash flow to equity as well. Might as well go the distance, use free cash flow to equity and sustainable growth, and see if in fact you can justify whether the S&P 500 is fairly valued, high, overvalued, undervalued. Now, I mentioned the biotech bubble, right? And you heard about, can I use this at a sector level? Can I do what I did for the S&P 500 at a sector level? You see what I mean by sector level? Can I take the tech index and see if it's fairly valued? I don't see why not. If in fact there is an argument about a sector being undervalued or overvalued, we should be able to value the entire sector. It'll be a little more complex if you're looking at biotech or young technology companies, because you can't stop at 5 years. You probably have to go almost like valuing a young growth company. But I don't see why we cannot use the technology we have for individual stocks to value entire indices, value subsets of indices, value entire markets to make a judgment of whether a market is overvalued or undervalued. Questions? So that was the starting point, because in a sense we valued a very easy company, Con Ed, a slightly more difficult company, 3M, but you could see how even slightly more difficult companies can be complicated by macro changes, and we value the S&P 500. I could keep valuing companies like this over and over, but you're going to get bored because you're going to see the same mechanics play through. So I'm going to skip, and here's what I'm going to do. I'm going to talk about valuing difficult to value companies, because if you can value difficult to value companies, then all the other companies are going to look like child's play, right? Saying, what do you mean by difficult to value? The way I'm going to frame almost everything I'm going to do from this point in time is to, when I look at the value of a company, I'm going to look at answering 4 questions about the company. And this is going to be true no matter what company you're trying to value. The first question I'm going to ask when you have a company to value is, what are the cash flows you're getting from your existing investments as a company? So think about whatever company you want and think about what the answer would be. Second, I'm going to ask, what is the value that will be added by expected growth? Notice how I framed that question. Not what's your growth, but what's the value added by growth. So to do that, I've got to factor in both the good stuff from growth, which is my earnings go up much faster, and the bad stuff from growth, which is the reinvestment. How risky are the cash flows on this? I didn't ask you what your beta was. So if you don't like betas, give me another measure of risk, but how risky are the cash flows? And when will your company be a mature company? So when is valuation simplest? When it's easiest to answer those 4 questions. If I can answer those 4 questions easily, valuation is simple. That's why when you value money-making companies with a long history like 3M, valuation is simple. And I ask you, what are the cash flows of existing assets? You show me your 10Ks and your annual reports. When I ask you what's the value from growth, you can have a long history of return on capital and margin that you can point to and say, I make 15%, the cost of capital is only 8%. When I ask you how risky is your company, you can show me either betas with lots of years of stock prices or earnings volatility. You have lots of data to back yourself up. And when I ask you when will your company be a mature company, you know enough about the life cycle that you can say it's going to be right now, it can be in 5 years, or it can be 10 years. So valuing money-making companies with a lot of history is easy to do. When does valuation get difficult? When those 4 questions get difficult to answer. And that's going to happen, A, with young companies. Why? Because the narrative is still there. I remember the Uber example we did in class last session. It's early in the process, so answering those 4 questions become difficult. It's difficult with companies that don't fit the accounting mold. Is it the right spelling for mold? Or is it the mold that grows? Whatever it is. Right? So you know what I mean. The accounting mold being a manufacturing. So if I have a technology company or a pharmaceutical company, valuation becomes more difficult because I have to kind of fix the accounting problems first. And with companies that face substantial truncation risk, distressed companies, companies that face nationalization risk, terrorism risk, anything that can put an end to the life of your company quickly is going to make it more difficult to value the company. And those are the companies I want to spend the rest of the next 2 sessions talking about, because if you can value those companies, you can definitely value the 3Ms of the world. Everything is relative. And next week I want to value Lukoil. Why? Because then after I value Lukoil, if I come back to value ExxonMobil, it's going to seem like child's play. It's like valuing a bond, right? So go where it's darkest. It's a message I keep delivering. Go where it's darkest because A, your skill set will get stronger, and B, you feel much more confident than when you come back to the rest of the market. So here are some of the difficult to value companies I hope to deal with in the next 2 sessions. I'm going to start by talking about companies across the life cycle. So I'm going to start with young startups and move all the way to the other end of the spectrum, which is not just mature companies, but companies that are beyond mature, declining companies. I'm going to talk about companies across markets, developed as well as emerging markets. I want to talk about companies across sectors, financial service companies, technology companies, pharmaceutical companies. So by the time we're done, you should have a wide sweep of companies ranging the spectrum across markets, across sectors, across life cycles. So let me start with what I think is usually the place where you get challenged the most. It's when you're asked to value a young startup. To see why it's difficult, you play the role of a founder of a young startup. Okay? And each of you has a dream, right? You want to be the next billionaire. So let's say you have a dream. You're a young startup, and I'm going to try to value. And I'm going to ask you the 4 questions that I said I'd need answers to. So you ready? You're the entrepreneur, you're the founder, owner of the young startup. Here's the first question I ask you. What are your cash flows from existing assets? What's your answer going to be? What existing assets? I don't even own the chair I'm sitting in. So that was easy. There's nothing there, okay. Then I ask you, what's the value that you will add with future growth? What's your answer going to be? A lot. And I ask you, can you be more specific? Well, you don't even have a product yet or a market yet, so you have nothing to point to. So I know it's a lot in your mind, but I have no idea what that number is. Okay, let's move. How risky are you? Say very. So can you be more specific? You can't show me a beta or earnings, and there's nothing to show. When will you be a mature company and you fall on the ground laughing? You're a young startup. You might not even make it through this evening. Every question becomes difficult to answer. Notice I said difficult, not impossible, difficult to answer. And because it's difficult to answer, people get tempted by what I call the dark side of valuation. What the heck is that? Let me actually make it even more difficult for you. When you value companies, there are 3 places you go to get information to value the company. And if you've started a DCF valuation, this will sound familiar. The first is you look at the most recent financial statements of the company, right? Hoping to extract information on revenues and margins. Second, you look at the history of the company because it's nice to know what happened after the crisis and the previous recession because you can use that in your valuation. And third, you look at other companies in the sector to see what large companies look like. So in other words, you look at the company's financials, you look at its history, and you look at comparables. One by one, I'm going to knock your crutches out. Let's say you're valuing a young company. What do you not have? You have no history. Young company early in its life cycle. There are financials, but they tell you nothing about the company because you sold very little. There's no margin stuff. And what if every other company in the sector looks just like your company? They're all young companies early in the life cycle. You can see why this is the trifecta you hope doesn't hit you in valuation. This is when the dark side beckons and says, come on over, you can't value this company. And you hear this message from VCs who should know better. You can't value this company. And then you start to see some really bad practices. Practices that are all over the place, but bad practices. Like what? People talk about paradigm shifts, which means I have no idea what's going on, so I'm going to call it a paradigm shift. They keep inventing metrics you've never seen before. Like what? The .com sector, it was, market value per website visitor. Now it might be, market value per app download. It could be, if it's Snapchat, market value per picture snapped out or whatever. My daughter alone has accounted for 18,000 Snapchat pictures in the last 2 years. She Snapchats everything. She alone, I think, accounts for probably $500,000 in value at Snapchat. I wouldn't be surprised if that's what they're doing, is they're saying number of pictures sent, market value. So it's metrics you haven't seen before because none of the old metrics work. You can't divide by revenues because there are no revenues, no earnings, of course, they're all negative. So what do? You use a metric. And people tell macro stories till the cows come home. You ask them, why are you buying this company? They talk about online advertising being a big market. You ask them, why are you buying Tesla? They talk about electric cars in the future. So why investing in Uber? They talk about car sharing as the move. In other words, they don't want to talk about the company. They want to talk about the macro story. Those are all signs that people don't want to engage in the hard questions, right? What are your earnings? What's your market? What are your margins going to be like? I know it's difficult to do, but engaging in this, going over to the dark side basically means you've given up on value, that it's all about pricing. It's all about mood and momentum, and you're going to live with it and you're going to die by it. So that's why I'm going to argue that when you're tempted to go over the dark side, I'm going to beckon you back. I remember doing these sessions late in the 90s. I'd be doing a valuation session and I'd talk about the peak of the .com boom. I'd do a session on discounted cash flow valuation. At the end of the session, somebody would come up to me and say, you really cannot value Amazon using a discounted cash flow model, can you? And then this finger going like this, and please step back, you're going to hurt me. Right? Very aggressive people. And the answer they wanted to hear from me was, oh, no, you can't use a discount. Do whatever you want with Amazon, because that gave them the license to go out and do what they wanted. And at the risk of grave personal injury, I would say, no, you can value Amazon using a discounted cash flow model. And they'd give me this look of total contempt. It's academic. The way they said it wasn't meant as a compliment. It basically was, you really can't value companies, you can just talk about them. And after about the 5th or 6th time of being called an academic, I got really pissed off. I said, you know what? I'm going to value Amazon using a discounted cash flow model. And the first time I did it was in late 1998. And I kept a journal while I was valuing the company. Journal of what? Every roadblock I ran into and what I tried to do to get around the roadblock. And to show you how many roadblocks I ran into, by the time I was finished valuing Amazon, the journal was 75 pages long. And I never waste anything I write. So I slapped a title, on the journal called The Dark Side of Valuation, Can Amazon.com Be Valued? I put it on my website. Some publisher somewhere, it was Prentice Hall, saw it, and I get a call the next month saying, would you be willing to convert it into a book? Some 75 pages in already. I'll add another one. So the first version of The Dark Side of Valuation came out of that. And Amazon is where I learned how to value young companies. What I'm trying to say is nobody's born saying, I know how to value young companies. You learn. This is a craft. You learn how to value startups by valuing startups. Not talking about them, but valuing them. So what I'm actually going to do is I'm going to take you through my valuation of Amazon. This is not in 98, but in early 2000. And I'm going to use this as a vehicle to talk about why I value young companies the way I do today, because that effectively gave me the framework that I still go back to when I want to value an Uber or a Shake Shack or whoever else I might be faced with. So this is January 2000. I know none of you were in the market then, unless you were very precocious youngsters trading when you were 6 or 7 or 8 or 10 or whatever you were then. But this was the peak of the dot-com boom. The NASDAQ had just hit 5,000. And Amazon was the belle of the ball. It was trading at about $84 per share. So I did this as a webcast for AIMR. It was actually one of the first. AIMR is the parent organization for the CFA, and this was one of the first live webcasts, which in 2000 was really not that live and not really a webcast. Right? It was a guy with a camera tracking you, and the questions had to be not quite interactive. Okay. So I'm going to take you through that valuation, and while I'm doing it, please don't let hindsight drive your view, because you're going to say, you were wrong on that. I'll admit up front, I was wrong on every single number, and it doesn't bother me in the least. I was wrong on the revenues, I was wrong on the margins. If I were right, then I have some freakish, satanic ability. I've entered into some kind of pact with the devil. You should be really nervous. Right? So let me go back and show you what Amazon looked like in early 2000. It had revenues of $1.1 billion, which for a US retailer is almost no revenues, right? To give you a contrast, Walmart's revenues are more than $300 billion. Costco's revenues are $60 billion. Even the Gap is $20 billion. So $1 billion is tiny revenues. And they had an operating loss of $410 million. So there are small revenues and big losses. So my task is laid out for me, right? To make this company valuable, first I've got to make the small revenues into big revenues, and I'm going to make the operating losses into operating profits. We did this with Sirius, but let's repeat it. So the first thing I said was, let me make the small revenues into big revenues. It's so easy to do on a spreadsheet. The first number as I said, this is a live webcast, I said I'm going to assume a compounded revenue growth of 42% a year for the next 10 years. I'll come back into why I use 42%. And I hadn't even finished saying it. I told you it was a live webcast. People were emailing questions, and somebody was pushing the emails in front of me. Very distracting. So I finished saying 42%. The first email question comes in. How come you're being so pessimistic about future growth? I said, pessimistic? Here's what I'm doing. I'm making $1 billion in revenues into $41 billion in 10 years. And you're accusing me of being pessimistic. You know why it sounded pessimistic though? What were they comparing the 42% to? They were comparing the revenue growth in the most recent year, which was 200%. So they missed the compounded in the 10 years. I actually projected revenue growth of 150% in year 1, but I couldn't keep it at 150% for the next 10 years because compounding starts to work against you. So the compounded average growth rate is 42%, so I made the small revenues into big revenues. When you're valuing young startup companies, the first thing to do is take your pessimist hat off and put it somewhere else. Bring it out later. When you value these companies, you've got to act like the company is going to make it. You've got to take you have plenty of time to bring in the pessimistic view afterwards. But here I'm assuming that Amazon will not just make it, it's going to become a big retailer. So half my task is done. Small revenues have become big revenues. What's my second problem? They're losing money, right? I want them to make money. Their margin right now is minus 36.71%. If it stays at minus 36.71%, I know exactly what Amazon is worth. It's worth nothing. So I had to project a target margin. What's a target margin? That's what I expect Amazon to make once it gets to steady state. And that target margin that I used was 10%. Where did I get that from? Not by looking at other .com retailers because they were all losing money, but by looking at established brick and mortar retailers and the average pre-tax operating margin across specialty retailers. So it's higher than what you get for discount retailers. It was roughly 10%. I am a realist. I don't think this will happen next year. So it will happen over time. So I will go from minus 36.7 to plus 10, and you will see that pathway that I've devised to get it from here to there. So that makes my losses into profits. I'm getting there, right? Small revenues have become big revenues. As my margin improves, my losses become profits. There was one more loose end to tie up. To make my small revenues into big revenues, I've got to reinvest. And I talked about it in the context of Sirius. This is where I got stuck on my original Amazon valuation. I first tried the return on capital times reinvestment rate and very quickly had to abandon it because both numbers were negative. I tried to get an analyst projection of growth in earnings, but that didn't work because there was the earnings were negative and you get not meaningful. So I looked at last year's capex and working capital. It told me nothing. There was almost nothing in the financials. So I decided to tie my reinvestment to the one number in my valuation that I know is positive right from the beginning, which is revenue. So I tied my reinvestment to revenue. And the ratio that I used was that sales to capital ratio that I talked about before, which effectively means for every $3 in revenues, I'm going to assume that Amazon has to invest $1 in capital. At $3 in revenues I got by looking at, again, across all retail firms, that's the rough average of the sales to invested capital. That gives me my reinvestment every year. So this is my optimistic outlook for Amazon, right? In my optimistic outlook, look at what my free cash flow to the firm is. Minus 931, minus $1 billion, minus 989, and that's exactly what you should expect to see when an optimist values a young startup company. In fact, you should be very suspicious of valuations of young companies where you see astronomical growth and cash flows are positive right off. In fact, I sent you the Tesla valuation last week. If you get a chance, go back and look at the DCF valuation. I actually emailed the analyst who did the report, and I said, there's a little problem in your DCF. Could you take a look and tell me how you're coming up with the numbers? And he actually got back to me almost right away. I think he was afraid I'd write some kind of a blog. I wasn't interested in exposing him or anything. I just want to know, how do you, because he was, the reason I was very, very surprised was he was actually, I'd done a valuation of Tesla way back. I got a value of about $70 the first time I valued Tesla, with about $65 billion in revenues in 10 years. That's fine. People can disagree about what those revenues should be. This guy was projecting revenues that were actually lower than mine, a margin roughly equal to what I was projecting, and he was getting $350 per share. So I started looking, what is it, where is this value coming from? And it turns out that he has no reinvestment built into the model at all. None. Right from the beginning, the cash flows go out as free cash flow. And that accounts for $230 or $250 per share. If you are going to value a young startup and you're giving me these visions of incredible growth, you have the obligation to tell me how you're going to get this growth. It's not going to happen by magic. It's going to be less expensive at some firms than others, and that's going to show up in the reinvestment. So my free cash flows. Now do you see what we're implicitly assuming in this DCF valuation? I talked about DCF valuations being going concerns, right? What am I assuming is going to happen in year one at Amazon? Minus 931 million free cash flow to the firm. Take it to its, in terms of, if you were running Amazon, what do you need to do in year one? Anybody? Go ahead.
Like raise capital.
You need to raise capital. Am I telling you where they're raising capital from? See this debt ratio in your cost of capital? I am assuming not only will they be able to raise 931 million capital, but that 99% of that capital is going to come from equity, 1% is going to come from debt. That's what the debt ratio does. And that they're going to be able to do this year after year for the next 6 years. I'll be quite honest, when I did this valuation in early 2000, that didn't faze me at all. A .com company needing to raise more capital, how much easier can it get? But as a what if, you can ask, what if I can't do that? What if capital markets shut down? And if capital markets shut down, even if every number you've estimated is right, do you see the problem you're going to have with your DCF? You get to the end of year one, you're $931 million in the red, you need to raise capital, capital markets have shut down. What's your first thing to do as Jeff Bezos? What can you do? First, you can cut back your reinvestment, right? You can say, look, I don't have to grow, let me survive. But even after that, you have negative. But equity, equity requires a market too, right? So if that door is shut as well, the game is over. This is how most young startups end their lives. Is the numbers can come in exactly as predicted, but they're very dependent on the capital markets being open and accessible, because without that, all these growth plans can turn to dust. So that's why I engaged Mark Cuban on that private share market, public market thing, which is the private share markets are able to raise capital precisely because the public markets are doing so well with these companies. They're not independent. And if the private share markets shut down, then of course these young growth companies are going to start to truncate very quickly. Somebody's going to be getting a lot of bargains. The Apples and Googles of the world will be buying companies for pennies on the dollar. But that's the assumption we're making in DCF valuation when we have negative cash flows for the next 3, 4, 5, 6 years, is we can raise the capital to cover that. So those are my cash flows. So that's my cash above the line, right? You go below the line. Yes, Rajiv.
How does the sort of the future price at which you raise the equity come into calculation?
It comes in your intrinsic valuation. You're assuming that it's happening at your intrinsic value per share. Okay. If you want to build in a pricing assumption, you can. But then you have two things floating around your valuation, right? You can say, well, I know the intrinsic value is 25, but I think for next year the price will stay at 80. But you then have to make some judgments about when that price will start to decay. And my suggestion is keep your intrinsic valuation in intrinsic valuation. Make everything about intrinsic value per share. So what I'm assuming is in year one, the value per share will be roughly 37 or 36 or 37. And it's going to be today's value per share times the cost of equity like we talked about last week. So I can give you my estimated value per share. That's what I'm implicitly assuming that these shares will get issued at. To the degree that you can issue those shares at a higher price, I will get a higher value for the company. And that's one of the reasons if you're an overpriced company, you're going to be in a hurry to do acquisitions with that, because that basically reduces your reinvestment needs to the degree that you're overvalued and pushes up your value per share today. Yes, sorry.
As you go forward, similar question.
Yep.
Would you change or how do you predict your market value of debt in out years to get your cost of capital?
I'm sorry, when you say market?
So to get your ratios to get your cost of capital, you need market value of equity in out years.
Right.
How do you project that?
Well, it's actually very simple to get how much dollar debt you will need. So here's what you need to do. See these debt ratios, I don't have the debt ratios, but I have debt ratios here. It's actually very close to 0% for the first 5 years and it grows. When I do an intrinsic valuation, I get a value of $14,587 for the equity and $14,936 for the firm. Just like I did last session, got target prices, I can get value in year one, value in year two, value in year three. And the debt in that year will just be the percentage of the debt ratio that you've used in your cost of capital times the value of the firm in that year. So you can actually convert it. If you want, rather than keep it as debt ratios, you can convert it to dollar debt. And you are implicitly assuming then that you will issue that much additional debt in year 6 and year 7 and year 8. And because you're issuing it, at that time the market value and the book value will be the same at the time of issue. Okay? So the dollar debt in future years will just be the debt ratio in year 6 times the value of the firm in year 6, the debt ratio in year 7 times the value of the firm in year 7. And you can actually come up with a debt schedule. And that's what you would do in an LBO, for instance, when you're changing the debt ratios, is come up with a debt schedule.
What about equity? What about the market?
The equity takes care of itself, right? Because whatever's not debt becomes equity, right? So basically it's going to kind of fall out of that same process. So if you can do the intrinsic valuation right, everything else is an output from that process. So I've got my cash flows, yes?
In this case, you're saying the truncation risk is less because you have unlimited access to capital?
Well, at least I perceived that there was unlimited access because of the time that as I said, it's almost impossible to divorce yourself from the world you're in when you do a valuation. And in early 2000, it looked like, I would love to tell you that I could see the dot-com bubble bursting in 2 months, and I didn't. So I was caught up in the optimism of the moment, and that's why. So 2 months later, if I'd done this valuation, I might have started attaching a truncation risk.
My question is, if you don't see access to capital, what are some other ways that you can deal
Leave the
with
DCF as is, right? You get a value per share with the DCF. Then ask yourself a second question. What's the chance that there's truncation? If there's truncation, what's going to happen? You have to sell the business for whatever somebody will pay you. And guess what? It's not going to be 14.6 billion. It might be for your patents and it's going to be a fraction of whatever that is. In fact, that's exactly the technique we're going to use with distressed companies, is we're going to do the DCF as if there was no problem with truncation. Then we're going to bring the truncation risk through a decision tree. And then ask, what's the payout? What am I going to get? And many of these young startups, if you have truncation risk, you get nothing. There's nothing really to sell other than the hours you spend building the business. Right?
does it become like an expected?
Exactly. It's an expected value. So basically what I'm doing is I'm drawing on decision trees and probability analyses to deal with truncation risk, because it's very difficult to deal with it in the context of a DCF valuation. So I've got my cash flows, and in my cash flows, what am I assuming? That Amazon is going to go from being a young, money-losing, high-growth company to a large, money-making, mature company in my cash flows, right? Forget about all the mechanics of cost of capital. Just think in terms of intuition. If I'm making that assumption in my cash flows that it's going to go from a young, money-losing, high-growth company to a money-making, mature company, what would you expect to see happen to my risk-adjusted discount rate over time? When I start the process, it should be a high number. Why? Because you're a money-losing company, you probably can't use any debt. What are you going to do with it? Your equity risk is probably going to be high. So my cost of capital initially is going to reflect the company I'm looking at. And that's what I started with. My cost of capital initially was almost all equity funded and reflected the fact that Amazon was a risky company. But I have to stay internally consistent, right? So by the time I get to year 5, here's what Amazon looks like on my spreadsheet. It has $19 billion in revenues and $1.6 billion in operating income. It is no longer in my spreadsheet a money-losing young high-growth company. It's now a money-making company. And even if you don't agree with my assumptions, I have to stay consistent with that assumption. So my cost of capital starting in year 5 starts drifting down towards the cost of capital of a mature company. I've talked about this earlier, but I want to re-emphasize this. There is often in DCF valuation, you act like you get one chance to get the cost of capital. You get multiple shots. And if your company is a young company transitioning, your cost of capital should transition as your company transitions as well. So I start at 12.84, I end up at 9.61%. By the end of the process, I'm at a 20% debt ratio. My beta is close to 1. My cost of equity and cost of capital reflect that of a mature company. So I have a cost of capital that varies across time. I discount my cash flows back to today. How does that work? Saying, no, how to do discount? Let's see. Well, how do I discount the year 1 cash flow? Let's start easy. I take the 931 minus 931 and I discount back 1 year at 12.84%, right? You're saying, why are we doing this? We did present value and foundations. Take the year 7 cash flow, 177 million. How do I get the present value of that number today? Can I take it and discount it back at 11.96% for 7 years? I cannot do that, and here's why. Because I have almost like forward rates in bonds. I have a cost of capital that's different across time. So what do we need to do? If I have costs of capital that change over time, I actually have to keep track of a compounded cost of capital. You know what I mean by compounded? It's going to be 1.1284 times 1.1284 times 1.1284 times 1.1283 times 1.1281. So basically, and if you look at my DCF models, you'll always see a line for compounding. You're saying, why is he wasting our time doing it? This is why I do it. Because if I use the present value function in Excel, it's going to screw me up. Because the present value function in Excel takes one discount rate and applies it across. So my present value here of all those cash flows, including the elephant in the room, which is that big terminal value, and that's always going to be there, is 14.9 billion. I add cash, I subtract out debt, I get a value for the equity of 14,587 million. There's almost no cash. There's almost no debt. But then I have to subtract out options. Remember we talked about how damaging options can be if they're granted like free currency. in a risky young high growth company. That's how much Amazon has already given away of its equity in the 5 years of its existence. Aided and abetted by its accountants, it issued options like free currency. And there it is. They've given away almost 23% of the company to managers. And this is why I think we need to start to attach a reasonable cost to options when they're granted, because we treat them as free currency, they're going to be given out like free currency. I subtract out the value of the option that takes care of that deadweight cost of having options outstanding, and then I divide by the actual number of shares outstanding. I don't have to do diluted because I've already factored in the option value. And the value per share that I got in this, what I thought was optimistic valuation of Amazon, was about $34.32. Stock was trading at 84. Can I go back and tweak the numbers to push up my value? Sure, right? But this is one of those cases you can tweak as much as you want. You're not going to get up to 84. Right? So here's what I'm going to do. I'm going to take this valuation and draw some very general lessons that I still try to remember whenever I sit down to value a young growth company. And you're welcome to take whatever lessons you want out of this and come up with your own. Remember what I said about regression betas and not trusting them when we talked about valuing any company? That goes in spades with young growth companies. You can show me the beta for Tesla and Twitter and Facebook as much as you want. I don't believe them because it's short time period, a changing company, and a very volatile history. In fact, when I did my beta calculation for Amazon, this is what the raw beta looked like, 2.23. Looks pretty good, right? Second decimal point. But look at the standard error on that beta, 0.50. The true beta for Amazon can be as low as 1.23 or as high as 3.23. That doesn't surprise me. Young companies, regression betas are going to be incredibly noisy. So what should you do instead? Use bottom-up betas. In the case of Amazon, for the first 5 years, I used the betas for .com retailers as my bottom-up sector. For the year 10, I used the beta for all retailers because I believe that once they got past that initial phase, there'll be retailing first and online afterwards that drove the way we think about risk. So that's the first one. Second, let me give away the secret on how I came up with the 42% compounded revenue growth. I made it up. I made it up with a mission in mind. In fact, this is going to sound incredibly strange, but when I sit down to value a young growth company, I don't think sequentially. Sequentially being what will the number be next year, 2 years, because I'm going to go crazy. By the time I get to year 3, I'm going to be pulling my hair out. I kind of try to visualize what I think a successful version of this company is going to look like, assuming everything works. I said, you know what, Amazon is... in fact, even in 2000, I thought Amazon was an exceptionally well-managed .com company with a vision in mind. I thought it would succeed as a big retail company. And the question I had to answer for myself was, how successful will it be? So here's what I did. I took the 10 largest retailers in early 2000. None of them were .com, obviously. Companies like Walmart and Macy's. And I put the list up. And I asked myself a question. In 10 years, where on this list would I expect Amazon to be? Do I expect it to be Walmart-like, in which case the revenues would be 200 billion? Will it be? So that was my starting point, and I put it 6th on the list. Basically, I said, based on what I see at Amazon, in early 2000 was still a much more limited retailer than it is today, I see it becoming the 6th largest retailer in the world in 10 years. That gave me revenues of about 41 billion. That's it. I know what the revenues are today. I know what I want my revenues to be in 10 years. All I have to do is fill in the middle, right? That's where I made up the numbers. With one small rule, which was my growth rates would decrease as I got bigger, because scaling up, it's going to get... So the only thing I followed was that 150% growth in year 1 becomes 100% in year 2, 75, 50. If you have a big issue with the 150%, you believe it should be 167.35%, you can have it. In fact, you can have all the middle 10 numbers if you leave me the end number. It's a point I make about young growth companies or young startups. The younger the company, the more I make this. The value of this company is not determined by what happens in the next 6 months or the next year. It's what happens the end game that drives the value of the company. That's why when you look at the earnings report for a young company, don't get focused on what was the earnings per share last year. Ask yourself, what am I getting out of this earnings report that changes my vision for this company 10 years out? And you know what? 95% of the noise will disappear because much of that earnings report is so focused on what happened in the last 6 months that you lose sight of that big question, because that's what's driving the value of the company. And that's why last session I said Facebook has, my valuation of Facebook went from 37 to 60, partly because as those earnings reports came out, my vision of what a successful Facebook would look like 10 years out has shifted to become a larger, more profitable company. In my vision at least, Facebook now could be larger than Google 10 years from now because of what it's done in the last 2 years. I don't get that same connection at Twitter. My vision for Twitter is exactly what it was when they went public, which is an online advertising company, which stays an online advertising company, still struggling to figure out a way to how to get advertising in through tweets. And until that changes, my intrinsic value for the company is not going to shift from the $25 to $30 I have right now. So values for young companies require changes in the end game, and that's what you see play out here. Any questions on, so that makes my small revenues into big revenues, and you can see it's the starting and the ending number that I focus the most attention on. It's exactly how I did Uber as well. Is I don't know what the revenues will be 2 years from now. Uber doesn't know what the revenues will be 2 years from now. It boiled down to what do I think the total market is and what market share am I giving Uber? Because once I got that, the rest of the numbers kind of flow out of that. Third, remember that scaling up is hard to do. It's like if you want, take that breaking up is hard to do song, convert it to scaling up is hard to do, sing it to yourself. Right? Scaling up is hard to do. And I promised you a chart and now I'll deliver. And this is actually a chart that looked at the revenue growth rates at companies that had just gone public. So it's actually from a study of all IPOs. It took these companies, it took the revenue growth rate in IPO and compared it to the revenue growth rate of the sector in which the company went public. So think of these as star companies, right? They've gone public, they're the young high growth companies. 1 year after the IPO, the revenue growth rate of these companies is 15% higher than the revenue growth rate of the sector that they're in. This is why I bought the company. 2 years later, the revenue growth rate is down to 7% higher than the growth rate of the sector. 3 years later, it's down to 3% higher than the growth rate of the sector. By the time you get to year 5, you can't tell this company apart from the sector. Most companies, high growth is very transient. It's a scary graph when you think about how much we pay for high growth companies based on past growth. It says, in most companies, this growth is not going to last. So when you sit there and project 30% growth for your company for the next 10 years, I'm not saying you're wrong, but you're already telling me this is an exceptional company. Think about why you think this company is exceptional. And you have to pay for growth. In fact, did I give the margins here? Yeah, I forgot to mention them. The way I got the margins going from where they are today to where I want them to be is I took the margin today, I took the end margin. I think I did this with serious work. I took half the distance to my goal. So minus 36.7 plus 10, half the distance brings me to minus 13.35. Hey. Again, if you feel that's too optimistic, we go to the Excel spreadsheet that contains this valuation. You can set it to a quarter of the distance. It means I lose money for a longer period. It's the simplest mechanism I could figure out to make you control the pathway to profitability. So revenue growth matters, margin improvement matters, the pathway to profitability matters. And then I estimated what the reinvestment would be each year by taking the change in revenue based on my growth rate and dividing by 3. That's it. No capex, depreciation, working capital, because I really have no idea how they'll grow. Amazon has no idea how they'll grow. It could be through acquisitions, it could be through infrastructure. So that's my reinvestment each year. Incidentally, I've left the sales to capital constant, but we talked about in the context of Sirius. If you feel there are economies of scale that will lead you to have higher sales to capital as you get larger, you can change the number. So it's the simplest device for estimating reinvestment. I put that in. Point I made at the start of class last week. With young companies, you always worry about dilution. Of course there's going to be dilution. They're going to be more, you know why there's going to be dilution. They have free cash flows, they have to issue new equity, either directly to the market or to pay for acquisition. So you know the number of shares is going to increase. And you worry about what will that do to my value per share. In the case of Amazon, that's going to happen. We know it's going to happen. My cash flow is expected to happen. But the nice thing about doing a discounted cash flow valuation right is it's already embedded in your value. You see what I mean by embedded in your value? Let me go back and show you the Amazon numbers. See these negative cash flows? If I take the present value of those cash flows, I come up with about $3.5 billion. So I've lowered my value by $3.5 billion because I have negative cash flows in the first 6 years. So if I hadn't had those negative cash flows, the value that I'd have got for the operating assets would have been greater than $18 billion. I've reduced the value of my assets by about 20% because of expected negative cash flows. That's the dilution effect already built in, which means you shouldn't be counting the shares. And this saves the issue of what Rajiv was bringing up of how many shares will I have to issue from the equation, because it means it's already built into your DCF valuation. Yeah.
Could you argue that if your price estimate is like much lower than the current market estimate, that the options that you do end up issuing will not be exercised, so that like...
That's actually an interesting question. You value the options, should you use the market price per share, which is 84, or should you use the intrinsic value per share, which is 34? You see the question? Because the market price out there is 84. So if you exercise the option today, nobody binds you to even think about the intrinsic value. I actually use the 84. And I'll tell you why. My concern is that the employees within the company see what I'm saying, which is that this price is too high, in which case what's going to happen? They're going to exercise early. My fear is if I put in the 34, in fact the Excel spreadsheet, I'll let you pick whether you want the price or the value per share. It's an option. Let me take that word back. It's a choice. But be careful about setting it at the value per share, because if you pay based on that then and people start exercising today when the market price is high, you've overpaid. Right? So you could try both and see what effect it has on your value. But in DCF valuation, the dilution effect is already built in. You don't have to adjust the number of shares for the new shares that will be issued. So you're not saying there won't be new shares issued. You're saying it's already in my DCF valuation. So I finished this valuation, as I said, it was a webcast. And at the end of the webcast, I get a very plaintive question from somebody clearly owned Amazon already. And she asks, is it possible that Amazon is worth $84 per share? What's the answer to that question?
Yes.
Possible is such a weak word. Of course it's possible. In fact, I'll tell you what has to happen for Amazon to be worth $84 per share. What has to happen? The revenue growth has to be a lot higher than my 42%, and my margin's got to be much higher than the 10%. So in fact, I did some very simple what ifs, and I've shaded out what you need to assume to get to $84. And it's very simple. Amazon has to grow like Walmart and have margins like Ann Taylor, and everything's going to be okay. In fact, there's a book called Expectations Investing that Mike Mabusin and Al Rappaport wrote, which I love. And what it does actually, it turns valuation, because usually in valuation you value the company and you compare to the price. What that book does is it takes the price and it backs out what the implied growth rate would have to be or what the implied growth period would have to be. It's a very interesting algebraic exercise. But remember, it's not taking the onus of making the judgment, because once you've computed that implied growth rate, what do you have to decide? Am I comfortable with that growth rate? Can I live with it? So ultimately it just delays the decision. Okay? So this is actually an implied growth calculation, implied margin calculation, and it kind of reaffirms to me that it's possible, but it's not. Remember the possible, plausible, probable distinction I gave you that session? It's possible, but it's not plausible. And if it's not plausible, it's definitely not probable. So it's not making that transition enough for me to invest. You're saying that's subjective? Absolutely. You might decide it's plausible and even close to probable. And that's why if you make that judgment, I have no problems with people disagreeing about the intrinsic value. Just don't not do a value and say, I disagree with you. Disagreeing is easy if you say, I don't like your value, give me an alternative. Tell me a story that I can live with, a narrative that gives me a higher value. You know. You do all of this valuation, here's something you need to take off your shoulders. I'll take it right off your shoulders. You're going to be wrong 100% of the time. Not 95%, not 93, not 100% of the time, and it's okay. You don't have to be right. You just have to be less wrong than everybody else. And guess what? With these companies, that's a very low threshold to meet. Because everybody's so horribly wrong that if you're just less than horribly wrong, you're a winner. And here's the irony. I am more likely to be less wrong than everybody else with an Amazon than I am with the 3M. Right? It's the nature of the process. You go where it's clearest, where it's easy to do valuation. What's the edge you're bringing to this process? So if you read security analysis, all the more power to you that you had the fortitude to actually sit through and read the whole damn book. But then if you stay in that little subset of the market where dividends are large and predictable, I don't see how you're going to be able to make money over time, because in a sense there's no disagreement about any of the big numbers in this valuation. So Con Ed, if I get a value very different from the price, I'm going to say, you know what, I probably missed something really big here, right? And it's very likely that if we all valued Con Ed, the values we'll get will range from 36 to 45. Because what are we going to disagree on? That the payout will be 71 instead of 73%, the cost of equity should be 7.21 instead of 7. We're debating fine details. Whereas if we value Twitter, the value range we're going to get is going to be much larger. And to me, that's opportunity. That's where, if you can value something, you're going to be able to bring the most to the table. And just to show you how much the numbers can change, I valued Amazon pretty much every year since 1998. So this is my 2001 valuation. 12 months after my original valuation, what's changed? The whole world shifted under me. The dot-com bubble burst. The economy went into recession. The conviction that online retailing was going to take over the world suddenly had become not so much of a conviction. People were convinced that dot-com companies were worth nothing. I revalued the company with a much lower growth rate, slightly lower margins, and a higher cost of capital, partly because the company had borrowed a lot more money. In fact, that's what saved the companies. They borrowed money in early 2000 and let them kind of ride out this crisis. But with those assumptions, the value that I got was $21. So this was my second webcast for AMR. And it came in response to a question of, will a dot-com company ever be worth money again? So in early 2000, the question was, can we value all these great dot-com companies? 2001, we said, dot-com companies must be worth nothing. So I finished the webcast. I come up with a value of $21 per share. And somebody had watched the previous year's webcast, pipes up and says, aren't you uncomfortable that your value changed so much in 1 year? And I said, are you kidding me? After a year like last year, if my value didn't change, there's something wrong with my valuation. The sector's changing, the economy, of course my value is different. And if you think I've changed my mind going from 34 to 21, how exactly would you characterize what the market's done? The market was $84, right, 12 months ago? By the time I did this webcast, it was down to $11.50. It shows 14 there, but the actual webcast date was $11.50. I forgot to mention the January 2000 valuation. The last question of the valuation was, your value is 34, the stock price is 84. Are you going to short the stock? And I said, not in this lifetime. January 2001, I was asked the question, the value is 21, the stock is at 11.50, are you buying the stock? I said, absolutely. So why am I giving I was actually more convinced in early 2000 that Amazon was overvalued than I was in early 2001 that it was undervalued, but I wasn't willing to act on it in early 2000. So what's the difference?
Unlimited losses on your shorts.
Well, I can go to zero, right? Really not unlimited. I hit zero, I'm done. Thank God for limited liability, right?
But you don't want to fight tape. You don't want to fight the tape. You don't want to fight
if I can fight it, I think the key is, what do you need to do to make money? The price has to move towards a value, and it has to do it over some period, quickly or not, right? So in fact, in early 2000, right after I did that Amazon valuation, I knew this question about selling short was coming. So I called around to see. And this was early 2000, where selling short on a dot-com company was incredibly difficult to do, even for institutional investors. I said, how many weeks will you give me? It's actually a physical broker who actually answered the phone. And he said, because you're such a good customer, I can give you 2 weeks. So he's saying, so I asked him, so basically he's saying, if I sell short, you want the shares back in 2 weeks? He said, yeah, that's what I want. You see why I didn't sell short? Because not only do I have to be right, I have to be right within 2 weeks. I don't have that much confidence that the market, I have confidence in my valuation. I don't have that much confidence. The market's going to agree with me in 2 weeks. In early 2001, what's the difference? I'm buying. I can hold on to it, and the only person I have to answer to is my spouse. And I turned to paperless statements a while back, so she doesn't even know what we hold. And if she does find out, I can always blame the kids, right? Maybe they clicked on Amazon and bought 1,000 shares. So I control my time horizon because it's my money, and I have to answer to myself. And I'm a very kind client for myself. Jordan manages other people's money, right?
No.
No, you manage your own money. Right.
What
You tell other people what it is. But if you're a portfolio manager, you see what the problem you face is? Not only do you need to have a long time horizon, your clients have to be willing to go along. And that's my competitive advantage in this marketplace is if I'm investing my money and I have to answer to myself, as long as I don't have liquidity crunches, that's my big, I can control my time horizon. So I'm willing to go long because I have time as my ally. It's getting better on the short side. It's not as bad as it used to be, right? You have puts on some stocks, you have long-term shorts you can go on others, but it still remains an asymmetric game. It's much easier to find something undervalued and take a long-term position on it than it is to find something overvalued and take a long-term position on it. I mean, as an example I give, what if you believe there was a housing crisis in 2007, a bubble? What were you going to do? Sell short your neighbors' houses? That would have been a nice tactic to try. Can I borrow your house for a couple of years and sell? I'd have made a lot of money, go around the neighborhood. But that's the reason in housing it's so difficult is it tends to be one-sided. So bubbles always tend to be big upside bubbles. You don't get big downside bubbles because there is this natural bargain basement strategy that can kick in. And in fact, I tell people, who ask me, do you own Amazon? I'd give them the right answer, the true answer, which is I've bought Amazon 4 times in the last 15 years. I've sold Amazon 4 times, which kind of tells you where I am with Amazon right now. But I've never believed in drawing lines in the sand saying I will never buy a high growth company, I'll never buy a technology company, I'll never buy a young company. Because I will buy any company at the right price. And in this case, Amazon is one of those companies. I mean, I've used this analogy before and I'll use it again. Young companies, markets are manic depressive. They're either over-optimistic or over-pessimistic. They overshoot or undershoot. Which means that if you valued a young company and you discovered it to be overvalued, don't throw it away. Keep revaluing the company. One of these days, you will be buying the company. One of these days, I'll buy Tesla. Just not at 194. And I promise you, some point in time, there will be a point where doesn't always happen with every company. I've been waiting for that buy point in Google for 10 years? It's never coming, I guess. So that train left me in the station. But for most companies, if you wait, especially young companies, the ebbs and flows of the markets will give you the opportunity to kind of get into those. So next class when we'll start on mature companies. It should be relatively simple to value, right? Because everything is in place. The only problem is everything is in place. And when everything is in place and companies are doing what they've always done, sometimes they get into bad habits. So next class when we start, we'll talk about what to do to value young, mature companies if they're in transition, if they're changing.
this company.